So, hi everyone. Welcome. Welcome to the first session that we're running as part of getting accounting firms and bookkeeping firms ready for 2026. We have David with us for a session that we really waited and really hope to have for quite some time. This session will be recorded and we will share and we will upload that to YouTube. So everyone can revisit, or you can share with friends. And the reason why I'm really excited about this session is because when I met David a while back, like I think it was a month and a half ago, we had a very deep discussion about the importance of GAAP accounting, but also cash flow management. And I understood that there's a part with cash flow management that we sometimes miss. That 70% of the businesses, and David will talk about it, are actually running out of cash, and then they shut down. What's the meaning for us as firm owners is that if our businesses are running out of money and need to shut down, it means that we will need to focus on finding new clients, and by that we will probably impact our growth projection, our revenue projection, and it actually impacts us. And David here is mostly to teach us how to look at cash flow and managing cash flow, not just for us, but how can we do that and help our clients, and by that protect our own firm. So I'm going to give David the stage.
Thank you, Elad. I want to jump right into it and talk to you about my client, Wally. Wally is this icon for me. Real name, not his real picture, but it's a real story. I met Wally. I was assigned to him. I was working for a firm, and it was a turnaround firm. And I went and met with him. I sat down, and we talked. And he said, David, I've got this huge issue. I've got to make payroll in 2 weeks, and I've only got $3,000 in the bank, and I don't know how I'm going to make a payroll. And I said, well, show me your finances. And I looked at his finances, and he had made $250,000 last year on $2 million in sales. And he said, David, I'm so frustrated because my accountant's telling me that I made this money. And he showed me his statements. And I said, well, what does he say when you ask him where your cash is? And the response Wally gave me is, I just don't know. And he was near to tears. There are too many small business people that are near to tears. They're not sleeping well. They're frustrated. They're angry because their financial statements tell them one thing and their bank account statement tells them something else. And that's what we're going to talk about today, about minding that gap between the two and how we can rationalize it and help our small business owners sleep better at night and have successful businesses. So before I go any further, I want to tell you just about what I consider a small business. Definitely under $20 million. Don't worry about government definitions of small businesses. The biggest thing is these businesses don't have a really good grasp on the accounting function, and they don't have a finance function for sure. Accounting's one thing, paying bills, collecting, sending out invoices, but finance, which is more the theoretical, forward-looking, absolutely none. So that's what we're talking about today. And what do they focus in on? They focus in on two things: revenue and GAAP profit. And revenue, let's talk about why revenue. Everything we hear about a business's revenue. How big is your business? Nobody ever says, I've got $100,000 in cash in my bank account. They say, I've got a $2 million business, which is referring to revenue. When we hear the news, what do news people talk about? So-and-so sold so much this quarter. Revenue's up. Sometimes then we hear about profit. Earnings are up or down. But earnings are GAAP accrual-based earnings that have nothing to do with the reality of how much cash is going into or coming out of the bank account. And it's usually never mentioned by newspaper reports or by online reports or by television, radio. The headlines never talk about it unless there's a disaster in the making for these large companies. So we need to help the business owners get away from the popular culture of revenue and GAAP profit and into what really makes a difference for them. But why don't they see it? It's because they're blind to a couple of key things. One, which I call balance sheet blindness. They will not see debt repayment. They don't see money coming in either. If the cash is coming in, it's not counted as profit, but they certainly don't see the cash going out as they're paying down debt, and a lot have debt. They don't see inventory. Boy, have you ever tried explaining to somebody about that their accounting, their P&L doesn't show the expenses for inventory until after you sell it? Their heads almost explode trying to get this concept through to them that an asset becomes a different asset. It doesn't become an expense. Now, a lot of you are professional bookkeepers, accountants, etc. You go, but David, it's so easy, it's so obvious. But think about how long you spent in school learning about this. You might have spent 2 years, 4 years, you might have a master's degree. Over and over again, you've learned this and internalized it. Me, I passed the accounting 101. Not the first time, I dropped out. I actually did pass the second time, but I didn't get a good enough grade to count it towards my graduate school coursework, so I had to take it a third time, and that's when it finally clicked. This is not easy and obvious. And so small business owners are not in business to be accountants. They are in business to do something that they fell in love with. They're technicians with an entrepreneurial itch, per the E-Myth. And so what else are the profit and loss? We've already talked about loan paydowns aren't there. Cash becomes inventory. Cash doesn't go out of the P&L. And the capital, if they're putting money in, they're pulling money out, that doesn't show up either. My friend Wally, all three of those things were happening to them. He was paying down debt, he was turning cash into inventory, and he was putting more capital in. So he didn't see any of this, and yet it shows making $250,000 accrual-based profit. But are we talking just about accrual? Well, let's talk about the results. These are two studies that were done. Relay is a bank that focuses in on helping small businesses become profitable. They've got some good services, and they've done a study on an ongoing business. Not only do the small businesses have problems, but they don't see them. And then I've actually talked to Jesse, who did this study. So they don't see them coming because the nature of accounting is history, looking backwards, looking to the past. When we're trying to stay out of cash problems, we're going to be looking forward. And I'll talk to you about that, how to look forward. So, GAAP is for big business. That's the conclusion I've reached. Is GAAP is for big businesses, and it's great. We need it. But cash is for small businesses. And that's what we're going to be talking about today. Small business cash management and why small businesses need it. But not just cash-based accounting. That's an easy one. You just flip the switch. Forward-looking cash systems so people can see a problem coming before it hits their bank account a week or two before a payment's due that they can't make, like my friend Wally. Let's talk basics. Now, you might say, David, this is overly simplistic. Just bear with me because there's some relevance to it. At some point, and I want you to do something, go and put in the chat how old you were when you had your first bank account. Now, maybe it was a checking account or a savings account that was a custodial account your parents had, but put it in the chat. Because for most of us, it was pretty young. I think I was about 8, 16, 18, 16, 10, right? I was about 10, 8 years old. I had somebody who's in my program say it wasn't until he was in the university, 13, 8, 10, 14. You see, this is young. We start learning really young. And we get that and we're taught by either osmosis or we just read or somebody explains it to us. You have a beginning balance. Let's say somebody put $100 in there for you. And then when you put more money in, it's a positive and it goes up. When you have expenses, you subtract it out. This is simple stuff. And then you do simple addition, subtraction, and you end up with an ending balance. Okay, everyone gets this, right? I know it's simple, but it's super important to realize that this is part of the problem. Accounting's not simple. What I'm going to show you is. All right, number 2. Green is good. Red is bad. Green is go. Red is stop. At some point in most cultures around the world who use accounting systems, these two things are the case. Good is good and bad, green, red. So now I want to put those together into a forward-looking cash flow projection that is real. I did this for a client. It was a new client. This was 2 months ago. It was in July. And I'm going to show you. This is consolidated, not the real company name, but these are real numbers that we used. And I want you to see a couple things. Number 1, there is a beginning balance. Number 2, there is our deposits or projected cash coming in. Real cash, not revenue. So that means if you've got a check and it takes 7 days to clear, it doesn't show up this week, it shows up next week. Then you've got money going out. Then you've got an ending balance, and that ending balance becomes the new beginning balance. This is super simple, and everybody can understand it. And then when is there a problem? You don't even have to try hard. You look for the red number. This is not theoretical. This was a real client, and this was the reaction after showing there's 2 men. They're good business people. They're experienced business people. This is the reaction. This makes more sense. They hadn't seen anything like this before. They were trying to understand accounting reports. They had large company, public company experience, but yet they were trying to run a small business and they couldn't get their hands around it. The other thing was their industry experts said if you just do this, it was firing a key employee who also generated a lot of revenue. It's basically firing their salesperson. You should be fine. Well, we did that exercise. We pulled out that expense line. They weren't fine. The industry expert, who was an expert at their industry, but didn't know anything about what real cash flow management was and that you need to measure it. You can't just guess if something's going to work or not. You want to be able to see the results. And then finally, they became aware of what cash flow was and this concept of focusing in on money coming in and going out of a company. So the next week, I talked to them again, and they had their best cash flow week ever. And all we had done is look at that projection. Why? Because it changed their mindset. They started thinking about finishing up projects. They're a car repair shop, if I hadn't mentioned that. And so they started saying, what can we get done now and not roll into next week? What can we do to get people to leave their cars here and not take them home? So they started doing some different things, and they had their best cash flow week ever. We didn't figure out whether or not it was their best P&L week or not. Didn't matter. Their mind was changed, their mindset was changed, and they were golden just by looking at a forward-looking cash flow projection. So why should you care at all about this? What does this have to do with you? You're an accountant. You may or may not be working with small companies right now. You're probably going to. If you're not working with small companies yet, that's probably why you're here. Why should you really care? Well, let's talk about businesses and business failures. If you are working with small businesses or even large businesses, even more so because you're probably working with fewer larger businesses, you should be asking yourself, which ones are poised for failure? Do I see some that are in trouble? Whether you're a tax accountant or you do their bookkeeping or you do their general accounting, you can spot symptoms like bank balances going down, debt going up without any real additional value to the company. And you can start identifying who is not only wants it, but is desperate for cash flow help. And believe me, they don't always say, I want cash flow help. They'll say, I don't know how to make payroll, or they say, I'm not sleeping well at night. The business isn't doing well. Cash flow isn't a really well-known term either to most small business people, but that's what they're talking about. So the biggest question you should be asking yourself is, who's going to fail next year? 50% of all new startups will fail within the first 5 years, but you go out to 10 years, it's 70%. So many small businesses fail. They don't thrive. They don't even survive. So before I move on, I want to ask you a question. Put it into the chat. Do you know how much it costs you to get a new client? It's called client acquisition cost. If you know, put a number into the chat. And if you're struggling, just say round it off, 500, 1,000, 2,000, or just say you don't know. 500, 1,000, 2,000, more than 2,000, or you don't know. Go ahead and put it in the chat. I'll wait for a minute. 500, 200, 500. I don't know. Great. I did this presentation, 500, for a bunch of CPAs. It was about 500. The biggest answer was $2,000. But the majority of the answers were very high, and some don't know. So I want you to see, let's talk about the cost of failure. Part of it is just revenue, right? You've got a 3% failure rate, and I'm using 3%. Most people would say, no, it's higher. And if you want to put in what you think your client turnover rate is on a yearly basis, failure, or they just can't afford you anymore, go ahead and put that in the chat as well. But if it's 3%, you can do the numbers easily enough. I use some round numbers. It's costing you money every year. And then if we look at client acquisition cost, there's a firm that goes out and figures this stuff out, does surveys, whatever it is, the magic they do. And they, for the accounting industry, identified $784 per client. Now, part of that is not just hard costs. And if what you're counting is like advertising, if you're counting on your website costs, that's one thing. But think about the amount of time and energy you spend fielding phone calls from potential new clients, that 1 hour introductory call, the onboarding process that you really can't charge for. All those are included in client acquisition cost. So when we put it together, if you lose those 3 clients and you want to replace them, we're talking about $5,300 in hard costs in this example. And you can do your own calculations. And right, Tova says, I think nothing is I don't advertise. But Tova, you're the perfect person to think about what else are you doing to generate clients. They don't just show up one day and hand you money. Are you networking with people? Are you going out into the community? That's your cost, is your cost per hour of your own time or other people in your team perhaps. So where do we go from here? The other cost is lost opportunity cost. And in this particular case, if you were to just have one of those clients identified and say, hey, I can help you. It looks like you're struggling with your cash flow. I can help you identify areas to improve and to be able to flatten out your cash flow and be able to have more cash flow consistently, but I'll charge you a fee because it's a lot of value add. And it might be more than the accounting work that you're doing that you're able to add. All of a sudden, if you can charge one client $2,000 a month, which is not unusual, I'm not giving you like the highest fee by any stretch of the imagination. That's all of a sudden another $24,000 a year, and you don't lose the client. So how do you do this? I've been able to put together a fairly simple system called the Cash is Clear process. And you don't need to take notes because, as Aloud said, we're recording today, but you can go back and referring to this. I'm going to tell you exactly how to do this. It is fairly simple, but I'm going to start off with the hardest thing, and that is mindset. Mindset. We've already talked about one aspect of mindset. You got to stop thinking, and when I say you, I mean the world, stop thinking about revenue and stop thinking about GAAP-based profit, because a couple things. Number one, it's the past. We want to look at the future. But number two, it's a made-up number. And boy, I get into some really big debates about this, but accounting is theory. Right? Accounting is principle-based, and it's theory. It's not reality. Cash in your bank account is exact, and it's reality. So accounting, you've got to be exact. You're supposed to be within, other than things that are de minimis, there's another accounting term for it, but you've got to figure it out. And some people are still using cents, which round off to the dollar personally. But you have to follow rules, GAAP-based rules that you have to follow to do proper accounting. And you're looking for mistakes. You're looking for problems. You got to document everything, especially if you're going to have an audit. Then you've got to have it documented. And then you have to explain all the reports. Some people say, well, just use the cash report. And that is the most confusing report out there. So, worst idea in the world, show them a cash report. You'll be there for an hour or two trying to explain it all. But on the cash flow basis side, when you're looking forward, you actually are trying to be creative. You're looking for the trends, the tendencies, and what's going on in a business. You're digging deep to find opportunities, finding problems, and then solving them once you know what the root cause is. And it doesn't have to be perfect. Matter of fact, I guarantee every one of my clients that their cash flow forecast is wrong. And it's very liberating because I know that they won't have the exact deposits. I know they won't have the exact expenses, but we're doing a best guess. And the more you do it, the better it is. And the closer in it is, the more accurate it is. And what you are trying to do is see, are we going to have a pit? Well, I'll tell you one client. It was amazing. This was weird. 13-week cash flow is the typical cash flow model. And we did 13 weeks. Look great. We'd see the last week of the 13-week model, and all of a sudden, they're in negative balance. And we were like, what in the world happened? And it took a while to figure out. They had two large expenses. Two that leapfrogged each other, that never hit on the same week until week 13. And then all of a sudden, you had to pay both expenses on week 13, and the bank balance went negative. And then the following week, we extended it out a 14th week. Yep, it not only came back, but it was very high. I call it the trampoline experience effect, the trampoline effect. If you've ever done that on trampoline, you're bouncing with a partner, two people. All of a sudden you hit down at the same time, you go really low, and then it pops you up into the air. It happens with cash flow. And so, but they were 13 weeks out. That's a whole quarter. You can fix so many things if you've got a quarter. You can get a loan, you can get a line of credit, you can move the payments around, you can split the payments out, you can try to bring in more money early. There's all sorts of things you can do if you're a quarter out. What about if you're a week or two out? All of a sudden your hands are tied of how much you can do in that short of a period of time. So, okay, I digress. So the number one thing in this cash flow system is mindset. Let me show you the other 4 steps. So mindset changes and grows as you move forward. The first thing is the modeling, which we've already talked about. It's just a simple cash flow model, which takes a little bit of time to learn, but it's relatively simple. It's technical, but not too excruciating. It's basic math and trending. Then you're going to learn how to manage the cash flow, and managing is simply moving the pieces around, trying to bring in something or push out something. You can even bring in expenses if you wanted to. It's a really good way to increase your overall cash flow is offer to pay somebody early, and if they'll give you a discount. And you might be able to increase your long-term cash flow. That's one of the challenges, that if you are just reading the popular press, most of what you read are management activities, and most of them are short-term cash flow focused. That's going to come up in the final step. We're going to talk about why that's not the way to go. But so you're helping yourself short-term. Give a discount, for example, on an accounts receivable. Hey, Elad, if you pay me this week the $1,000 you owe me, I'll give you a 10% discount. Only pay me $900. Well, that makes me feel good. I've got $900 in my pocket this week, but I've also discounted it $100, which means I won't have that $100 to spend down the road. So I'm helping myself short-term, long-term. I'm killing my profitability, and I'm killing the amount of cash I've got to pay for my expenses. So managing, sometimes the best strategies for managing are the opposite of your popular wisdom. All right, let's move on to mentoring. When you are working with small clients, you've got to be able to teach them what you have learned and to show them how this works. Why you have to unprogram them to stop worrying about revenue all the time and start worrying about cash flow. Not all, just using this as an example of mentoring, not all cash flow is good not all revenue is good revenue. Let me give you an example. I worked at a Fortune 50 company, and I was given responsibility for a division in Latin America. They hadn't turned a profit for as long as anybody could remember. The first thing I did was look at the profitability of the products, and some were losing us money. I cut those much. You wouldn't believe how much the salespeople screamed at me that was killing their opportunity to earn money, that people were buying this stuff. But every time we sold one of those products, we were handing the client money because we lost money every time. Our revenue went down and our profitability went up. Now, we didn't worry about cash flow, but when you're a small business owner, it's the same thing. Your revenue might go down, but your cash flow can literally go up by focusing on certain products and dropping other ones. But that you have to teach people. It's a hard concept, and you get to teach people a whole way of thinking. So once you're starting to do that, then you can move to the maximization. And that's where I taught you about get away from the short-term strategies that are costing money and go into the long-term strategies. Like instead of offering a discount, take the discount. I already mentioned this. Go to your biggest vendors and say, listen, if I pay you early, will you give me a discount? Or take advantage of the discounts that are automatically offered. Or here's a mind blower. You ready for this? Offer your clients to pay over time, but they just have to pay you a little bit more. That's maximizing. I mean, if you're on an annual, if you're on a one-time annual fee for tax accounting, for example, and it's $1,000, offer to let them pay $100 a month. That would get you $1,200, and it would flatten out their cash flow during the year. A lot might not go for it, but some of your clients might kiss you on the cheek if you have a in-person relationship saying, thank you so much. It's a problem every year. I got to come up with $1,000. This would be much easier for me to do. These would always be win-win situations when you're doing these types of things. So let's move on. These are all the maximization strategies I've got. I've got 230 strategies that help improve cash flow, or better yet, manage cash flow, because some of them short-term gain, long-term pain. You got to use those when you're in trouble. But here's why I like Anchor so much. And I'm an Anchor user, and there's a bunch of reasons. Here are the cash flow reasons. And then I'm going to talk about the other reasons. So the cash flow, these are strategies on this list. I went through and said, okay, here's the 4 that are on my list that Anchor addresses. One is reducing cash transaction fees. Even better yet, number 3, the third bullet, is that the client pays for the transaction fees. Boy, if you're at 3%, 4%, 4.5%, and you get rid of those transaction fees, you got 2 things. Number 1, your cost is reduced. But if you have 10% gross margins, net margins, 10%, and you get rid of a 3% credit card fee on every single client, all of a sudden your net margins go up 30%. They don't go up 3%, they go up 30%. You go from 10% margins to 13% margins. That is absolutely huge. And you get your funds deposited faster also. They've just implemented a new system. It's in a day or 2 now, which is absolutely fantastic. But let me tell you, I saved automatic invoicing for last because it's time. Just like when we said, well, what about client acquisition costs? What does it cost you? What wasn't mentioned by a lot of people or don't think about is your time. And I no longer have to send out invoices. I still have one client who wouldn't sign up with Anchor, and I still have to go into QuickBooks and invoice them every month. And then sometimes I forget, and it's a pain. And the fact that it's automatic now saves me a ton of time. But one of the things I didn't put on here, because it's not a direct strategy, is the amount of time and energy I'm saving on setting up the agreement. I used to send an agreement. I'd say, please print it out and then sign it and send me back a scanned copy. I would then also do the same thing, and I'd send it to them, a completed contract, and then I'd first invoice them, and then we'd get going. Now it's all within the Anchor system, which is why I love it. And the more I use it, the faster and faster and faster it is for me to set up new clients, get them that invoice, and for it to jump right back. So, all right. If you haven't tried Anchor yet, and by the way, they're not paying me to talk about this. This is just because we like each other that we're doing this webinar. I believe in the product. They believe that we need more people doing cash management for small businesses. That's why I'm telling you about it in case you haven't been exposed to Anchor yet. So there's a journey that everybody will go on, and the mindset's there, and there's a lot of different things you have to do as you're learning about modeling, and you do the forecasting. That's a skill. Then identifying the peaks and valleys, but there's mindsets all along the way. I'm not going to get into this really deeply. There's no reason to, but just to let you know, there's a journey. So you might be saying, what happened to Wally? Well, 3 weeks. That's how long my engagement was with Wally. In a period of 3 weeks, we found and fixed more issues than it would take me a whole hour to tell you about all the good things we did. But let me tell you what the most important was. Not only did he have enough money for payroll, when I left him, he had enough money in the bank for 2 or 3 months payroll, and he knew how to get more. Why? because we focused in on what was going to bring cash into the company. Whether it was accounts receivables being collected and we didn't discount, we put a system into place. Or if it was liquidating inventory, and I don't mean putting it all on sale and having a fire sale. He had certain inventory that was paid for, other that wasn't paid for. By rearranging, literally physically rearranging the inventory in his store, we were able to get more cash in. There was 4 or 5 other major strategies we had, and it took 3 weeks. It was full time. It usually takes longer than that. But listen, if you want to learn more, it's great spending this time, but I've put together this ebook, Boost the Bottom Line, 24 powerful cash flow strategies that you control, not your clients. If you go out and say, hey, send me my money now, who controls that? Your client does. If you say, but I'll give you a 10% discount, you control the discount. Who controls the decision? Your client still does. So these are strategies that you and your clients are in complete control of. Grab the ebook. You'll learn some details. You'll learn some really interesting concepts, including how to think about it. So that is my presentation for today. Hopefully you have a good grasp on how this all fits together and why you need to mind the GAAP when you're doing GAAP basis accounting.
That I had to be honest. This was really impressive. I learned a lot, and then I reflect back when I was a firm owner. I had my own marketing firm, and how many things I've done wrong. So first of all, thank you very much, David. For those of you who want to download the ebook, if you have any questions, we will take now questions. Write them down on the chat, and we'll show them and we'll share them with everyone so David can address. Oh, okay. So Tiffany wrote, I'm going to share that with everyone. So I'm going to show that with everyone. So the primary tool you use to help clients with cash flow is that cash flow projection tool. That's a question. You or your team manages updates for clients. Oh, I'm going to show that again. So longer this time. And client meets with them regularly. How did you go about training? And then it continues, your team on how to have these conversations. Do you update the cash flow projections manually? So those are a lot of questions altogether. Right,
Tiffany, those are great questions. So let me try to give you a picture. This is not the primary tool. That is a basic tool that's used. Banks use it for doing, they sort of use it for doing lending, but they always use it when you've got a loan in problems. They use cash projections. So, however, it's not the primary tool, it's the basic tool. The primary tool that we use is this list of 230 strategies because that's what gets things fixed. And but how do you do the projection? Because the first thing you do is try to find the problem. That's the projection. It depends. Everything you ask, I'm sorry, I can't just give you a cut and dry question. It all depends. Sometimes one of my team members will do the updates, but I try to teach people how to do this on their own. If they have an internal bookkeeper, we try to get the internal bookkeeper to do it because they should have these basic skills, just like bookkeeping. And regarding is it manual or automatic, generally it's both. There's certain things that are manual, for example, putting in the new bank balance. However, accounts payable, accounts receivable, we can generate reports out of accounting system and drop those updated figures into the spreadsheet. And then the spreadsheet has automatic populating. But that's not the important part. We use different models for different companies, and some are super simple without any automation at all for a small company. It all depends on what the client can handle. Regarding how do we have conversations? Well, this is part of the interesting thing is that most of the time, clients are very open to conversations, blunt conversations, because they really want help. And I don't know if that answers your questions or not, Tiffany, but that gives you an idea. And Tiffany, if for some reason you would like to have more of a discussion, please let me know. You can, when you go to CIC 60, you can go see my website and just send me a note, and you can we can have a conversation.
I want to thank you, David, for taking the time and teaching us a new perspective of things. I think that people hopefully found it useful. And everyone, we hopefully will see you on our future webinars. We have one in 2 days as well, talking a little bit more about generating more revenue for 2026. Thank you for those who join us. And thank you, David, one more time. I wish you all
Thank
have
you.
a great rest of your day.